It is Monday, 11:51 p.m. I'm actually making this on Monday. It's February 4th, and I have a big of a doozy of a video for you guys today. It might be a little bit long, so let me just go over. Um, Let me just go over. Okay, I just want to make sure the mic works. My portfolio, and I am at a new all-time high, as you can see right now, but that's not even a big deal anymore. It seems like I'm getting new all-time highs every day this month. It's a bit crazy. I am expecting a correction, especially since I've capped out my Apple holding gains, unfortunately, since it was up another 3% today. But I'm capped out at 165 because I've sold a call for 100 shares. And now look at how my liabilities increased to $678, minus $678 here. So it keeps going up. I'm not going to get any more gains past that. So I am expecting a correction in the portfolio overall, though it's a little overextended now. Yeah, I was hoping silver performs a little bit better. It's actually down on the day, but EXK managed to eke up a 3% gain, which is nice. And uranium also did all right. We have energy fuels up 6%. Chemical went 5.5. I wish that I didn't trigger a sell at $12. It's already almost at 13. I'm not even going to sell a call against this 100 shares left that I have. Unfortunately, it's only 100 shares, even though I think this company is really good. Because look at this 1 year chart. It's just a beautiful thing. Look at the 5 year. It's just a beautiful upward grind. It's amazing. So I wish I had more money in that, but oh well. Collected quite a bit of money from this company already, so um, it's done me really well. Okay, so that's chemical, energy fuels, and everything else. The uranium ETF is up 2.6%. It's definitely notable because I have a large position in that. It's $3,364 at the moment, 260 shares. I've sold a call against it for $14. All right, now let's see what do we have under. Oh yeah, I sold my Australian market position, and it looks like I'm getting a dividend payment from IGD. Now, what I want to talk about today, I want to talk about money. I want to talk about money, so let me switch over to scene here. All right, good. It's gonna look a little different for a moment. I'm gonna bring out the sketch on Sketchpad maybe. Whoa, that's bright. Okay, so what I want to draw here, I want to draw your attention to the Fed. The Fed, this is gonna be experimental. I haven't practiced this or anything, and it's gonna look real ugly. But what happens in a rising rate environment here and how the Fed, I think, is going to cause both inflation and deflationary crash. Inflation in the real market, in the Main Street, and deflation on Wall Street. I'm sorry, inflation on Wall Street, inflation on Main Street, and then deflation on both. All right, so whenever the Fed raises rates, this is, by the way, my theory. Now, it actually isn't very well known. So if you ask the Fed, they'll tell you they know exactly how monetary policy and how their actions affect the economy. But I mean, they don't. If they did, they wouldn't have problems now, would we? The economy would always be hunky dory. So what happens? This is my theory, right? If they in the rising yield, um, treasury yield environment. So whenever they start selling off treasuries, okay, into the market, the percentage goes up, right? The value of the treasury goes down. So what happens because of this percentage when it goes up? Um, Now this becomes more attractive to things like banks and lenders. Okay, so they start putting more money in here because they want the yield. All right. Now, in traders who have previously owned treasuries, they exit this, they front run this trade, and now they go into the stock market. All right, stocks. So the market starts going up. Okay, now because of the higher rate, we have higher default rates, and whenever somebody defaults, what happens here is all these dollar bills here that have been taken out of the bank as a loan, they're still out there, right? They're still out in the world. They're still doing their thing. They're probably in bank accounts and so forth, collecting, savings or whatever people do with their money when they receive them, business owners, etc. Like these are for groceries, for Walmart, for foot massages, for whatever. All right. But the consumers that borrowed all that money, they can't repay them back, right? They're not going back in there. They've defaulted because the rates are too high for them to handle or for whatever reason. And now there's no more lending, okay, because these guys are no longer going in here. All right, they're no longer lending to the general public. So now we have initially all this money is out of float, and we have what's that supposed to be here? No money going into the banks and lending for lending purposes, no money going out. So this becomes a little bit of a liquidity issue here. And then we have money piling into stocks from traders, all right, because um, they're looking at the value of the treasury, not so much about the yield. And so now it pushes the stocks up. Now this money over here, this probably also goes into the stock market, right? So especially people that are doing well, either they reinvest in their businesses or they invest in stocks, like their, retirement accounts or their portfolio or whatever, what have you. Okay, there's free money out there. So this temporarily, the stock market gets a real big boost here, even as the rates are rising. All right. Now the defaults hurt the banks and lenders. Okay, this is pain right here. So they definitely start buying this stuff up. Um, but the fact is that more money is being pushed to the stock market, right? But at some point, the rates become so large that these guys over here, they start running out of cash to deposit because their customer base is depleting, right? So whoever was getting money out of these guys that are defaulting, they're no longer getting money, all right? And what happens is that stocks, okay, um, are businesses that operate off of this cash, right? So at some point, the absence of cash, catches up, right? So this link here between the stocks deed is broken. Okay, so the earnings are no longer good, right? Goods are not being sold because people don't have money. And now this link over here is severed, okay? And you the stocks start having really, really bad reports. And what does that mean? That means that the stock market now starts going down into a recession. And basically, what it's telling you is that the consumer base isn't there, right? This is absent. These guys are in default. They can't make their payments. So, and now reinvestment dries up, right? This dries up. The link is severed. Okay, so there's zero money going to the stock market now. And what do the traders do? They go into cash. They go into cash. They sell their stocks because they see it. They go into cash, and now the cycle can start all over again. All right. Wow, that looks pretty. I don't know if this made any sense to you guys. It makes sense in my head for sure. My artistic skills are that of a 1-year old, so I apologize for that. But maybe I have made my point here. Maybe I've explained my theory somewhat. If you think this makes sense to you, let me know. If it doesn't make sense to you, either ask questions or suggest something or call me an idiot, whatever you want to do. So maybe we can get a little bit closer to the truth. But one thing I definitely don't believe is the Fed, because either they don't know what they're doing and they think they know what they're doing, or they do know what they're doing and they're causing problems on purpose, right? Because those are the only two options. If you think there are any other options, let me know. But as of right now, it seems to me that those are the options. Otherwise, we wouldn't have crises, right? Okay, so that's about it. Oh, look, it ticked over. Very interesting. This is the weekly gain, by the way, 3,000 up, not bad. Um, let me know what you think. Let me know what you thought about this theory of mine and or hypothesis, and if it does make sense to you, or maybe you have a different view on how the money mechanics and how it flows through the economy and why. And I'll be very interested to read about it. Um, in other news, my next moves here, I think, would be just selling some calls because I'm so high up. I'm really waiting for EXK over here to pop to 250 at least before I make any kind of sell. I am going to hold silver at least through February, I think, and then unload my positions because of that predicted bump in price that I have been predicting after a market crash like we had on in December. I laid out a theory of why I think the next 2 to 6 months usually see a metals rally, precious metals rally, especially a silver one. In 2008, it lasted like 2 years, but I think that in smaller crashes, it lasts for less amount of time. We can have another video or vlog on that conversation at a later date. For now, though, I'm going to leave you all right here. Hope you enjoy your Monday. Hope your gains are at least as good as mine. Um, if not more, that would be terrific if we're all making money. And I'll see you guys all later. Peace out.